If you ask a financial advisor how to build wealth, you will almost certainly hear the same golden rule: time in the market beats timing the market. That advice has worked perfectly since the early 1980s. For over 4 decades, passive investors have been trained to buy and hold index funds, bailed out time and again by a 44-year secular bull market that always seemed to push stocks higher. But macro strategist David Hunter argues that this supercycle has finally run out of room. We are currently staring at its absolute mathematical top. Most retail investors are entirely unprepared for a shift in the macroeconomic weather. Right now, portfolios are heavily concentrated in the specific tech and AI companies that dominated the last cycle, leaving them completely exposed. Blindly trusting the financial rules of the last 40 years is now the single greatest threat to your savings. We are about to enter a whiplash 3-stage financial reckoning. Despite current anxieties, the market is not going to crash immediately. Phase 1 is actually a final vertical explosion in asset prices, a parabolic melt-up. If we see a resolution to Middle East tensions, oil prices will temporarily drop, fear will ease, and sidelined capital will flood back into equities. This line chart illustrates a parabolic curve in practice. Over months, this surge is projected to send the S&P 500 shooting to 9,500 and the Dow to 65,000. Precious metals follow this vertical trajectory, with gold hitting $6,800 and silver reaching $180. But this euphoric melt-up is a psychological trap. It is designed to pull the last remaining skeptical investors all in, right before the floor completely gives out. That brings us to Phase 2. Sometime around 2027, the underlying math breaks, the trap snaps shut, and a sudden global financial bust takes hold. This scale visualization compares a standard historical debt load against the actual problem: $330 trillion in accumulated global private and sovereign debt, acting as a systemic pressure cooker. This sheer volume of leverage turns a typical economic slowdown into a forced liquidation event. Borrowers will be unable to roll over their debts, resulting in a crisis significantly worse than what we saw during the 2008 financial crisis. This spiral of forced selling is projected to erase 80% of equity values. Simultaneously, a global freeze in industrial activity removes the floor from the energy market, sending oil to $30 a barrel, while the desperate flight into government bonds drives the 10-year interest rate all the way to 0%. This massive deleveraging event will completely paralyze the global banking system, leaving desperate governments with only one remaining move to survive. In Phase 3, to stop the domino effect of rolling bank failures, central banks will be forced to flood the global economy with liquidity on a scale that was once unthinkable. The response will dwarf anything attempted in history. The Federal Reserve alone could inject upwards of $20 trillion into the financial system to artificially keep it afloat. This dynamic bar chart shows what happens next. That massive flood of liquidity triggers an inflationary supercycle, sending inflation rates skyrocketing past historical norms and surging toward 25%. As the currency devalues, hard asset prices will explode in the early 2030s. Oil hitting $500 a barrel, gold reaching $20,000 an ounce, and silver touching $1,000. The true danger of Phase 3 is that this extreme inflation will systematically destroy the purchasing power of any fiat currency you manage to save during the bust. When the dust settles, the broad stock market indexes that made everyone rich over the last 40 years will become stagnant, underperforming traps. This seesaw mechanism illustrates the core mathematical constraint. Price-to-earnings multiples, measuring what investors pay for profits, are the inverse of interest rates. In high inflation, climbing rates force PE multiples down, crushing valuations of tech and consumer stocks. Preserving your wealth will require a move out of the broad indexes and into hard commodities like copper, natural gas, agriculture, and mining companies extracting them. Because their prices inherently rise with inflation, these tangible assets are the only vehicles capable of outpacing a 25% inflation rate. The macro environment will soon overpower the Federal Reserve entirely. To survive, you must abandon the passive buy and hold strategies of the past, actively time this transition, and